Good morning, everyone, and welcome to Startups in the Law. I believe this is the 20th episode of Startups in the Law. We've done this every month since May of 2020. Welcome, and I think we're going to get started right away here. So what I want to say, though, before is if you have any questions, like Anna said in the chat, please make sure to drop those in the chat. We're going to be moving, pretty quickly through these slides. I've got quite a lot to talk about today. We'll go ahead and get started. Just to give you an overview of our law firm. Our law firm has two partners. I am one of the partners. I'm based here in Dallas, Texas, though we have presence in Austin, Dallas, and Oklahoma City. Matt Jones is based in Oklahoma City and basically runs the startup community serves a lot of the startups in Oklahoma in general, as well as North Texas. We go by two separate names in two separate states, but that is soon to change. We go by Verge Law in Oklahoma and everywhere else but Texas. In Texas, we go by JonesKertz. That's going to change at the beginning of January in 2022. We are going to change to Verge Law because we are now allowed to use trade names, and we don't have to go by our last names in the state of Texas anymore. We're super excited about that. We think it's going to be great for our clients. We think it's going to be great for growing our business and better serving the startup community here in Texas and throughout the nation. If you have any questions, though, if you have an Oklahoma-specific question, feel free to email Matt Jones, mjonesvergelaw.com. His phone number is right there as well. Give him a call. My email is kyle@joneskertz.com. Feel free to email me if you have any questions. We may not be going over some of the stuff that you're interested in hearing today. So if you have something that's unrelated to a topic that you want to discuss with me or ask a question about, I usually try to make myself available afterward and throughout the day afterward to talk to people and at least listen to what they have to say if they do have questions, because, while we do have a large bank of videos, we don't necessarily, cover everything in every single webinar. So some of this stuff is going to be more high level. Some of it's actually going to be a little more granular, and we're going to get down to the details on it. Feel free to give me a call if you have any questions as well. 214-736-4462. Aside from that, why we do this, as far as the mission goes, we believe that, serving startups early and partnering up with them as far as lawyers go early on, it makes them a lot more successful. They have a better shot at actually making it at making it past that first and second year mark, which are pretty critical. A lot of businesses in that first and second year, you probably heard 9 out of 10 businesses fail. With our clientele, our businesses don't really fail, as often as you would see out there in the general business world. We're actually, we attribute that a lot to, the guidance and counseling that we provide to our clients. And really, we do believe that a better, legal education, leads to a better legal foundation, and leads to more successful startups. And I'll say, over the course of the last 2 years, we have probably only had, I would say, 3 businesses fail. And actually, one of those businesses didn't fail. It was shelved. It was one of those businesses that made money while there wasn't a pandemic. And then when there was, the person who was running it just decided that they were going to pause running it and then pick it back up later to make additional money. But aside from that, not saying that all, pairing up with us or pairing up with a similar startup attorney or startup law firm it is for sure going to make you successful. It also is about the people running these things. It's about, whether you're planning and business planning, is there. So that said, we do help a fair bit with that. We answer the questions at the critical moments when they come up, and we address issues and produce contracts, to make sure that those things get taken care of. That said, topics covered for today. I'm going to go over Delaware franchise taxes and touch on a little bit of Texas franchise tax. The reason we're talking about this today, it's not the sexiest thing in the world to talk about, but in reality, when it comes to the end of the year, we have to remind people, hey, this is coming up. You've got a window of 4 to 5 months to take care of this before you've got to pay additional fees or penalties to the individual state that you're operating in. And the 3 most common states that we have because of our geographic area of practice are Oklahoma, Delaware, and Texas. Delaware, though, because that's the most common form of corporation for the startup clients that we have. I'm going to go over different classes of stock, and then I'm going to go over some capital raising and securities law stuff and tell you what you need to know. If you're attending again, you might have seen that I've done, some of this stuff before. I think it's important to touch on this from a different perspective, time and again, just to make sure that we're covering all the bases here and saying what I want to say about this stuff. Because, raising capital, and structuring companies is a very dynamic, fluid situation. And it does, there are some changes that go on. And some of the stuff I may have said in the past, I've either changed the way we do that sort of thing, or, I've changed my perspective on that because I've been shown something different that I thought was really cool and interesting and thought I would share with you. That said, we're going to go ahead and get started. But I think I have one more slide before we do. Legal disclaimer. Just remember that this is not legal advice for you or your business. Please don't act on this info without seeking advice from your attorney if you have one. If you don't have an attorney, I would recommend that you get one or pair up with one once you feel that you need to. There are no absolutes when practicing law. I have to tell this to my clients a lot. We frame everything based on the facts available and conduct research to reach legal conclusions. There's certain things that I do know off the top of my head, some of which is going to be covered today. There are certain things that I don't. Some of those things are research topics. Some of those things require that I look into it. That said, from a research standpoint, we know how to find those answers, and we can find them pretty quickly. So it's usually not that big of a deal, and usually there is an answer to what we're trying to do. That said, remember, you are not a lawyer unless you are one, and even if you are one, I wouldn't recommend that you just go try to do startup law unless, of course, you have some experience in it or you have some understanding that is a little more than that 30,000-foot view. You kind of do need to be in the weeds to do this and do it well. I've seen a lot of people try, and I've seen a lot of people fail that are lawyers and have tried to do it themselves and completely botched it, whether they claim to do this for a living or not. That said, let's go. I am going to actually talk about, New Year's resolutions. Okay. So, at this time of year, I basically tell people, you need to do a retroactive assessment. We call this a retro in some cases, for short. Take a look back at the previous year, if you're running a business right now, and figure out what went wrong, what went right, and how you can learn from that. And I think it's important that you look at what went wrong and potentially even draw it out. What went wrong versus what went right. So that you can see it. This is one of those things where if you have a team, I would recommend that you actually make this a team meeting and discuss this with people, because that's how you figure out, which directions you need to take. That said, now is really the time to be discussing with your teams, or, just contemplating changes in pricing and changes to terms and conditions for your service agreements and other things like that. You want to make sure you're plugging holes in, that you've discovered in your business, in a timely manner. And, I think, I think putting this on the list of to-dos for the new year is a great way to sit down and figure out what changes you're going to make and how you're going to implement them. To give you an idea, we sit down at the very beginning of Q4, and we always look at our engagement letter, we look at our pricing, and I look at my staff members, because I'm looking at who do I need to add, what space do I need to fill, and we are actually doing that. So we've decided we're going to increase prices because we're getting better at this. We're getting much more efficient. To give you an idea, even with the increased price, we're probably still, we might make a little bit more money, but in reality, we're working so much more quickly that, it's not going to really, I would say, impact the bottom line. I'd say the growth in revenue for us is probably going to come from, just growth in client amount, and growth in, the amount of work requested from our current and new clients coming next year. That said, as far as making these changes, sometimes you can implement these on your own. I said, if you're in need of a new service agreement or something like that, talk to your attorney, talk to somebody who can draft a contract for you. Maybe that's one of those things you need to get done. I do want to say this is not a business pitch, by the way, just to clarify. I'm not saying, attorneys are the best, or, attorneys are such know-it-alls that you need, to talk about these things with them. I'm just saying that, sometimes we see people who, in the first 2 years, they've been using, a service agreement that they got online. Maybe it's time you leveled up a little bit, right? Aside from that, service provider changes, take a look at your vendors, see if, your software is good or not, see if you can make it better, see if you can afford, the higher end stuff that'll make you more efficient. Take a look at your equipment, what you're using, as far as computers and things like that. We always take a look at what we do, because we want, as far as being efficient, it's extremely important, that you have the best equipment so that you can work as fast as possible. Starting new entities and businesses, this is one of those things where I usually tell people, if you're planning to start an LLC or a corporation, unless it is absolutely essential that thing be active this month, then I would recommend that you make the effective date January 1st, 2022. What this does is it gives you a clean tax break. You don't have to pay franchise fees to whatever state that you're forming it in, to the Secretary of State, or to the Office of the Comptroller if you're in Texas. Aside from that, as well, you don't have to file K-1s if it's an LLC, if you started on January 1st, 2022 until the next year, or, with a corporation, you don't have to file a corporate tax return, until the next year. You wouldn't have to do it until 2023 if you started on January 1st, 2022. Other changes, obviously up to you, based on your business. Everybody's different, but I want to clarify, time steals from everyone. The new year is a good reason to sit there and reevaluate things, especially when you've got a little bit of downtime and, everybody's on vacation, or everybody's taking a week off for, Christmas or the New Year's. I would just recommend that you make changes as quickly as possible, because the reality is, just because it's the new year does not mean that, you should be making these changes now. You should be making those changes when those issues arise and when you discover those problems. That said, that's my little soapbox. We're going to go ahead and get started and talk about Texas and Delaware franchise tax filing info. Okay. So effectively, for Texas franchise tax and public information reports, franchise tax and public information reports are due each year. Typically, most businesses are not going to make enough money to have to pay franchise taxes. Okay. Tax threshold for the year 2021 was 1.18 million. It's the same as last year. That might be going up this year because it's actually indexed, based on, I believe based on the consumer inflation rate. So we're looking at potentially, a new tax rate coming this next year, especially with the higher inflation that we've been seeing, which by the way, inflation has been around something like 5 or 6% recently. That's due in part, by the way, to supply chain problems. It's due in part, to the fact that wages are increasing for people, and everybody has basically decided that they're no longer going to take just $7.25 an hour, or getting paid $8 an hour, as the minimum wage. Everybody's expecting more, and rightfully so. For businesses operating in 2021, I should say, sorry about the typo, you have until May 15th if you're a Texas LLC or if you're registered to do business in Texas. So if you have a Delaware corporation or Delaware LLC and it's registered to do business in the state of Texas, then you have until May 15th to file a public information / no tax due report, which, unless you make 1.18 million, you're not going to owe taxes. Deadline, the deadline last year was extended. I don't know if it's going to be extended this year due to COVID. I think everybody's pretty much over that. And then tax due if your business made more than 1.18 million last year. By the way, the tax rate is, I believe it's 3.75%. It's extremely low. And it's really only it's really, not a super huge burden. State income tax in Oklahoma, for example, is something like minimum 8%, I believe. So aside from that, Delaware filing dates, you got until June 1st for LLCs, you got until March 1st for corporations. We get asked, what happens if I miss the deadline? Not a super huge problem, though we don't want to miss a bunch of deadlines, and we don't want to miss them for very long because we need to make sure that your company remains active. We don't want to have to pay to reinstate it because that can be really expensive. And the typical franchise tax filing, by the way, is going to be about $400, so long as your lawyer did it right. If your lawyer did it wrong, it could be astronomically high. But I'm about to explain how to calculate corporate franchise tax here in a second. File and pay the late fees and accrued interest if you do miss the deadline. What happens if I just let it go? If you just let it go, then technically your corporation or your LLC is going to be deemed inactive. Okay. If it gets deemed inactive, then the person who operates it, the officers who are in charge of the company, basically the principals, are going to be personally liable for the fees and accrued interest. Don't let that go for very long. That's going to be prohibitively expensive. Okay. The major takeaway here, by the way, file your annual reports and your franchise taxes ASAP after the first of the year. You should have, pretty much all your information. And from a business planning perspective, most people's fiscal year ends on December 31st. To give you an idea, I don't try to talk about how awesome we are all the time. But one thing I have tried our best to do, with our business at least, is make sure that the second January 1st rolls around, I can actually file taxes. Most people want to wait until the deadline. I'd rather just move on with my life. I'd rather not be doing taxes, under the gun on April 21st or like around the middle of April, right? So I would say, tackle this as soon as possible. Make sure you collect all your receipts. Make sure you take every tax deduction that you possibly can, and then go do these filings and file your taxes, right? Aside from that, how to calculate franchise taxes in Delaware. 2 methods of calculating Delaware corporate franchise tax. You have the authorized shares method, and then you have the most common method, which is the assumed par value capital method. It's most used because this is actually how we get the fee reduced all the way to the bare minimum, which is $400 for corporations. This method reduces franchise tax liability in most cases, so long as you did everything right. The author, by the way, you need to make sure if you have a corporation, this is where you have to check your certificate of incorporation. We have to see what the par value of your shares is and how many shares were authorized. Okay. Delaware Secretary of State has its own Excel spreadsheet to calculate franchise tax, which I'm about to show you an example of. You can Google Delaware franchise tax calculator, and it should come up pretty much as the first or second result. Highly recommend that you look into this. Highly recommend that you experiment with it if you're not familiar with it. We do actually help people with filing these. That said, I don't really charge very much for it because it's a 15-minute service. Doesn't really take very much time for us. this is kind of difficult to read, so bear with me here. And actually, I think I'm going to skip this just to show you the example of how this actually works. This is the assumed par value method. This is how we usually do this ourselves. So take a gander at this. Normally on a certificate of incorporation, okay, we issue a minimum, or on a certificate of incorporation, we authorize, a maximum of 10 million shares of common stock. That's the typical case. And then usually in contracts, we're going to issue, shares in the amount of 6 million among the initial founders. Okay, whether that be 1, 2, 3, 4, or 5 people, it's usually 6 million shares. And here you can see we have class 1, 10 million shares. We have the standard par value, which is, which is a 1 with 4 zeros in front of it, after the decimal. And then, we have here, what shows assumed par value capital on par value capital, and then it has this calculation. That said, you see the line item here where it says tax by par value 400. That's the number we want. That's the minimum that is owed. But by the way, we do not want, if you're coming up with a different number with this, you've done it wrong, or possibly your attorney has done it wrong. So make sure you're not paying more than 400. By the way, if you pay more than 400, the Delaware Secretary of State is not going to care. Okay. They're just going to let you pay whatever, so long as it's so long. They're going to let you pay, more if you mess this up, and they're not going to give you a refund. So I highly recommend that you get this right. And if you do have an issue with it, I highly recommend that you talk to the Secretary of State and figure out what's going on. Okay. So aside from that, if you have any questions, just feel free to email me. Not a huge, franchise taxes are not a huge deal right now, but, just remember after the first of the year, so long as you know how much revenue you made, so long as you know, how much you had in expenses, or can reasonably estimate those sorts of things. And, you can rely on that estimate as truth, or you can rely on it as accurate, then you can go ahead and file, your franchise taxes in Texas, Delaware, wherever else. Okay. Just remember that whenever you are filing these things, it's basically an affidavit. It's basically a legal statement of fact that you're affixing your name to, and saying, I believe that this is true and accurate. And so just make sure that it is true and accurate. Okay. That said, classes of shares, voting versus non-voting. I want to say this is a question that we get quite often. Do we bifurcate the voting rights of stock or not? There's a useful there's a useful way of doing this, by the way, and there's a useful reason for doing it. Sometimes we run into a situation where we've got people who are actually they're probably cream of the crop as far as startup founders. They're extremely experienced. They're the type of people who know how to produce and know how to get it, and know how to get from 0 to 1 really quickly. And they're also the type of person who just cashes checks and snaps necks. They just know how to run a business and know how to grow a business, right? And in some cases, we tell those people, maybe it makes sense that these people you're bringing on as service providers are non-voting. Some people, they don't want voting rights. They just want shares. They want to share in the equity. Keep in mind, though, that when you strip stock of voting rights, it actually does decrease the value of that stock. It has inferior value, mainly because voting stock, that has value. You can actually show up to meetings. You can actually vote your stock yes or no on certain issues that are put to you. It's important. And as a matter of fact, we actually can see in real time in the market that where the value has a difference. If you actually look at Google's or, I guess Alphabet, the company called Alphabet, they actually have Class A, Class B, Class C stock for sale on the public exchanges. You can actually go and look at those side by side and see that those stocks actually have different values, even though they're all practically the same ownership in the company. One of those stocks is non-voting, and one of them is 1 vote per share. So can be important as far as the value goes. And if you are getting a 409A valuation done, non-voting stock will be taken into account. and the person who's doing the valuation will basically say, yeah, the non-voting stock is going to have less value than the voting stock, obviously. And obviously voting stock is going to, normal voting common stock is going to have less value than, voting preferred stock, right? That said, so going through the types here, with common stock, we've seen single, dual, and triple class. I would say triple class is very rare. We don't normally see triple classes, three classes of common stock, but I'll explain why we've done that in the past and why I don't really like doing it going forward. Dual class is what I talked about, class A, class B, voting, non-voting, and then single class is just straight voting, 1 vote per share. Preferred stock, usually we're issuing preferred stock, at a Series A or a large seed round. The reason for that is institutional investors, they got to protect themselves from the company failing. They're also going to want superior liquidation preference, right? What liquidation preference means is that in the event the company, liquidates its assets, in the event the company makes a distribution of its liquidated assets to the owners, such as cash from their bank accounts or something like that, usually the preferred stockholders get paid first, and the minimum I'll tell you is going to be, they're going to get paid basically, up to the original purchase price until they've been fully paid out, up to the original purchase price that they bought in at when they first invested. That said, I've seen different, different structures there. Sometimes there's what's called participating preferred, which basically says, the preferred stock, will get paid out, until it reaches a purchase price of, until it reaches, X amount of the purchase price, whether that be a 1 or a 2X. And then it'll participate with the common stock on a pro rata basis, meaning, they're going to look at, preferred and common stock together, and then the rest of the distributions will be made that way, right? That said, blank check preferred stock. I previously said in a webinar back a couple months ago that I didn't like putting blank check preferred into the certificate of incorporation, but I've since changed my mind on that, and here's why. Blank check preferred, I will say, is more of a private equity concept. And make no mistake, venture capital transactions are just a form of private equity. Okay, it's basically the same type of deal, as a large private equity deal. It's just smaller, right? It's not that it's less important or anything like that. It is important. It's just there's not as many factors at play when we're looking at early stage startups, because we're looking at first line of products, we're looking at first services rendered, we're looking at first revenue made with some of these companies. So they're not as complex. They don't have as many employees. They don't have as many considerations to take into account when we're doing, large private compared to a private equity deal, large private equity deal. But blank check preferred stock, though, is useful because it can allow us to actually it can allow the board of directors to create it can allow the board of directors to create, a series of preferred stock without necessarily needing permission from the stockholders to do so. So basically, the stockholders, by incorporating a term for blank check preferred stock into the certificate of incorporation, they're delegating authority to the board of directors to be able to create this additional, type of stock, so that they can just go on and just do this, without needing their permission. That said, I will tell you, sometimes people resist this sort of thing, especially, when we look at, Series A deals, whether a term like this gets included, normally the Series A preferred stockholders are going to want control over additional issuances. They're going to want, to be the gatekeeper, to be the person that gives permission over that sort of thing. So just keep that in mind if you're adding this in here. If you're doing multiple rounds of deals, going seed, or you go pre-seed or seed, and then Series A, Series B, you're going to change the certificate of incorporation pretty much every time you do a major financing, because you have to. So aside from that, though, you can read this drafting note, which, explains a little bit of this, but you do have to file a certificate of designation, with the state of Delaware whenever you, create an additional type of stock that is authorized under blank check preferred terms, right? That's the general gist of that. Aside from that, voting versus non-voting, very common to do Class A versus Class B. Not as common as single class when we're starting out, but it's okay. I really don't mind creating, dual classes of stock, but I do mind creating 3 classes of stock, and I'll get to that in a minute. You can also alter things like liquidation preference and par value. The par value doesn't necessarily have to be 0.00001. You can make it 0.001. The reality is, where that's set, the par value, does not necessarily matter so much as there is a par value. But the reason we set it low is because, when we're issuing the initial stock to the shareholders before the company really has any assets or any value, we're basically going to say amount of shares times the par value itself equals, the amount that this person is paying for their stock, right? That's the general way in which we like to do that. And especially if we're issuing it under a restricted stock purchase agreement and it's vesting with that 1-year cliff over with that 1-year cliff with a 3-year vesting after the cliff, 4 years total. That's the way we like to do these so that we're not absolutely, destroying these people from a tax standpoint. If selling stock, you must disclose which type of stock you're selling and what rights it comes with. These people need to be able to look at the bylaws. They need to look at any stockholders agreements that they'll have to sign. They need to look at the certificate of incorporation. Recommend that you share the books, that you share at least those records with them. You don't necessarily need to share financial statements with them unless they have that right. But you just want to make sure that you're giving them all of that stuff so that they can see. Okay. We just don't want anybody throwing an accusation of fraud or that they were misled or that you hid something from them and gave them something that is not authorized under one of those documents. Just give the investors a certificate of incorporation and bylaws and, a stockholders agreement if you have one, if they're going to have to sign the stockholders agreement. Okay. 3 classes of stock. And I want to talk about this for a second. The instances in which we have done 3 classes of stock are instances in which we were creating what I call the Zuckerberg deal. Otherwise, you'd also call it the Newman deal, as in Adam Newman of WeWork, who had a very similar structure to his equity as to WeWork's equity as Zuckerberg did with Facebook, or as you know now, Meta. It's really not as common to do it that way, but a lot of times people do it that way because they think I'm Star Spangled Awesome. I'm the type of person who absolutely must have control of this company forever. That said, maybe Zuckerberg makes a case for that. Adam Newman did not make the case for that. Obviously, he got pushed out of his company, and SoftBank actually had to buy him out. But Zuckerberg is the type of person that clearly knows his business the best, and is clearly the leading visionary behind it. Whatever criticism you have of Mark Zuckerberg, I don't really have a real esteemed view of him. It's more that I recognize that the structure that he has protects him from ever basically protects him as the person who has prevailing majority vote and control of the board, as well as control of stockholders' votes, going forward forever. It's not necessarily anti-dilution, but it is actually, protection from others' decision making. And that's the main purpose for 3 classes of stock. If we're doing 3 classes of common stock, we're basically, creating one class of stock, which has, 10 votes per share or whatever number of votes per share that we have decided, and that can be arbitrary. And then, whatever superior rights that we may have decided. And then we've got Class B, which is 1 vote per share, typical rights, maybe the liquidation preferences are stacked Class A, Class B, Class C. And then Class C is non-voting. That said, the instances in which we've done this, the reason I don't really like it is because it comes off when you're doing a capital raise as extremely hostile to outside investors, right? If you currently have a certificate of incorporation that has these terms in it, you basically have to tell those investors, we're changing the structure of this company to be not this anymore. Unless, of course, you're sitting there arguing that you deserve 10 votes per share, which I'll tell you, anybody giving you tens of millions of dollars or even, hundreds of thousands of dollars is going to view, your outweighted votes, as hostile to them, just on its face. So keep that in mind. You may actually have to, alter it and amend and restate the certificate of incorporation to say that this is not going to be the case, right? And you just need to tell those people in writing that, hey, that's what we're intending to do. Possibly put that in the term sheet for your capital raise, right? Aside from that, though, like I said, this is about ultimate control. Like if that's what you care about, then do this. But and to give you an idea, the last time we did this was for a fintech company where the person who was running the fintech company had 12 established businesses and was starting a 13th, and that person generally, that person was a very high net worth individual, had been very successful, had done about $100 million in deals up to that point, with their other businesses, and had earned, hundreds of millions in revenue. The other person that I've done this for, and I've only ever really done this twice, in recent memory, was the type of person that I would consider to be probably the most, probably the hardest working individual that I have ever met in my life. Type of person who works 16 to 18-hour days, 7 days a week, and that is not exaggerating. That person is always on and always working. That person went from $0 to $1 million with their startup in 12 months. I can tell you for sure that person deserves to have this structure. They are the only person who deserves to have decision-making control because they're the only person who is truly working that hard at the company. That said, that person also, wanted protection in the event they were to issue stock to some of their employees. They wanted to protect themselves from people who would, I guess, attempt to push them out of the company. So we basically said, regardless of what the board structure is, so long as the share structure with 10 votes per share, granted to that person remains intact, there's really no chance that anybody would ever be able to push that person out of the business because they would always have, at least 50.1% of the company. So if you have any questions about that, let me know though. Cause it's just, I'm, by the way, like I will tell you as a lawyer, if somebody approached me and said, I want this, I would ask, how many businesses have you run before? Like, because quite frankly, if you're planning on raising money, this is not advisable. 3 classes of stock, is not advisable unless of course you are, unless of course you're the type of person who deserves this sort of thing. Here's an example from, this is basically ripped straight from the Meta certificate of incorporation. Okay. That said, it's pretty, like you can see the language here, it talks about Class A, it talks about 10 votes. Well, this is one example, by the way, actually, where I said Class A shall have no voting power. The reason for this is people, psychologically, when they think about Class A versus Class B, they'll always think that Class A is better, right? That's wrong here. It's part of the reason why we did it this way is because, for granting people Class A non-voting common stock under an equity incentive plan, then they're not going to protest the non-voting portion of this as much, so that's why we did it. And then we made Class B, voting common stock. And then this is actually for a particular client, where the Class C voting common stock was actually it's not expressly written in here, but it was basically just for people that were going to be members of the board of directors, right? So the board of directors would actually have voting common stock, and then everybody else, employees and service providers, would not have a vote. So does anybody have any questions there? I'm just going to stop here for a few seconds and see if anybody has any thoughts on that. As far as, conclusion here for different types, single class and dual class is great. Whenever you're doing capital raises, be open to giving out preferred stock. But if you truly, want to make it so that let me back that up a little bit. If you're doing a large round, if you're doing a Series A, a lot of times people are going to demand preferred stock. They're just not going to want common stock because they want to get paid out. They want to get paid out first if they have to liquidate. They want to make sure that they actually recover some of the money they spent on you if it's not working out or if you have to shut down. Okay, but yeah, just make sure that you're mindful of the different types of stock and that you understand that, because whenever you're discussing, term sheets and you're talking about terms, you really do need, to come off as sophisticated. You need to come off as knowledgeable about that, especially if you're the CEO or CFO. You absolutely can't, just be sitting there going, I have no idea what this means. You've got to be a little more into the weeds on this. I encourage you, educate yourself for as much as possible. Rewatch this if possible and watch our other slides, because I've got a lot more information on that sort of thing and some other ones that we've done. Private offerings versus public offerings. We're going to talk about capital raises, but in general, we're talking about, offerings of securities, right? So all of what we're talking about is going to be governed by securities laws, one law versus another law, which I'll get to in a minute. And more often than not, because we're startup attorneys, we see private offerings, right? Public offerings, we don't do public offerings for a reason. Number one, I don't have a team of 10 attorneys to just staff on a public offering, which is about what it takes to take a company public. You need a lot of people to be able to conduct due diligence, to review everything. You need to, you're going to spend months, and it's going to be, mission critical stuff where every single day these people, these lawyers are going to be working 12 hours a day, to basically finish your stuff, right? And the idea is, especially when keep in mind, public offerings, you're almost always doing them in tandem with an investment bank who is going to be a major underwriter. That's almost always going to be the case. They're going to take a chunk of, they're going to take a chunk of the securities and use that to make a little bit of money off the transaction. And then they're also going to take their fee, right? So, the underwriting and legal costs for doing a public offering is significantly higher than a private offering. That said, private offerings can be expensive too. To give you an idea, I negotiated a $750,000 capital raise the other day where, the legal fees were almost $20,000. And we actually had a term sheet that was where it stated that our fees, because we were representing the investor, were covered, under the agreement, meaning the company is going to pay us almost, up to $20,000 in the event, once the round closes, right? Private offerings, though, not listed on any exchange, but maybe listed on the crowdfunding website, so long as you comply with crowdfunding rules. Reg CF, though, regulation crowdfunding, I call it the non-exemption exemption, because you basically have to comply with all of the registration requirements that you would otherwise comply with for a public offering. And then, you're just running a pseudo private offering. I'll tell you, the difference is, there's a blurred line. I would say, complying with Reg CF is actually somewhat more expensive than doing it the old traditional way, which is not doing crowdfunding. Which, by the way, crowdfunding, you've probably seen ads for this sort of thing where, people are publishing stuff on Facebook or Instagram and saying, invest in our Series B. We're raising, $35 million or something like that. I have my opinions on that. I kind of hate crowdfunding because I think you're reaching the target that is not necessarily the target investor. You're reaching an audience that is not really a strategic investor either. Maybe you can do a portion of it, which is indeed, hey, we're going to do 5 million of a $35 million fundraise as crowdfunding to build up, basically to build PR, to build street cred and to build rep, right? Maybe that's the value that crowdfunding really has. But I would suggest that, the majority of your, if you're raising a large round, whatever it might be, whatever your perspective of a large round is, you might I would encourage you, go after institutional capital, go after strategic investors, unless you're doing like a friends and family round, or a pre-seed, in which case go after angels, go after people who have experience in investing in private companies, and people who, genuinely do have an interest in increasing their wealth, outside of the public stock market, right? Not, as far as private offerings though, obviously more likely to be early stage companies. Publicly traded companies don't really do a whole lot of private offerings, mainly because the cash capital that they're getting is just so substantial. Once they do one public offering, they tend to do, if they need additional capital, they'll do an additional offering, otherwise known as a secondary offering, which, by the way, whenever you do a secondary offering, you increase the amount of, you're increasing the amount of shares while also increasing the amount of assets, technically cash assets that they have, but also it generally just decreases the price of the stock just by function of, the increase in the shares. So that said, we're not going to talk about this anymore. We're going to talk about this, private offerings. Reg D and Blue Sky. Okay, so you've probably heard of Reg D if you've done startup, if you've done a startup before, or if you've done fundraising or capital raising for your business. You may have heard of Rule 506B or Rule 506C. Rule 506B is probably the most common exemption that we see for capital raises, especially in the seed stage. It's not as, I guess it's relatively common in Series A as well. But when we do, a Series A, we are looking more for, hey, the dedicated investors here, the ones that are getting in on this, are going to be more along the lines of accredited investors. So Rule 506B allows for up to 35 non-accredited investors. And what does that mean? Basically, people who are not high net worth individuals, people who are not millionaires by virtue of their total net assets, which does not include the value of their homestead. And then as far as, well, actually, I'll have to talk about the homestead thing. So scratch that. We're going to talk about accredited investor requirements here in a minute, and I'll get to that. Rule 506B, though, you get unlimited accredited investors. Keep in mind, though, you got to have a PPM. You got to make certain risk disclosures. For those people who are not accredited, they need to be given financial statements, and you need to give them, materials and information which is material, to the offering and to the risks of the company. What does that necessarily mean? There's really no set structure that the SEC has decided on that meets the threshold, but they do know when something is misleading and when something is not. So, if something is demonstrably misleading or inherently misleading, that needs to be taken out of the PPM or rewritten. That said, it's important that you comply with, with Rule 506B. We have people fill out an accredited investor questionnaire to tell us, is this person accredited? Is this person not? Rule 506C allows for general solicitation and advertising. So this is what I was talking about earlier. When you're doing Rule 506C, right? You can actually, publish on Facebook and Instagram, and you could even advertise on TikTok, and, you could put a link on your website saying invest, right? That's general solicitation. You're generally soliciting the public, for that sort of thing. And keep in mind, I have seen people attempt to do this with, no compliance whatsoever when it comes to filtering who's accredited and who's not. I once had, another attorney that I was, who, had a client that I knew of, and I was looking at this guy's website, and I had just sent him an email saying, keep in mind, your client is raising money for a real estate venture fund and indiscriminately taking money from the general public. I would highly I had to tell this guy, I would highly recommend that you not allow him to do this, that you tell him to take the website down, because he's not just breaking, laws that could lead him to be sued. He's also, potentially subject to seizure and enforcement action, which, by the way, that is a real thing. We actually, we were in the early stages of representing a brand new client when we started peeling back the layers on their current operation and realized that they didn't just have one or two compliance issues, they had a whole lot. And what we did was we basically were just sitting down with large law firms, telling them, hey, we're going to interview you. You need to represent these people with approaching the government, about its non-compliance, about its failure to comply. Because, and by the way, if you have a failure to comply, if you have an egregious failure to comply, you probably do need to bring it up to your attorney and ask them to help you figure out, how to overcome that. Okay. Because these things are important. You don't file the Form D, you break, one of these laws in a manner that, leads the government to believe that you failed to fulfill your duty as a company to your investors. You are potentially going to be liable for fraud. Securities law violations are no joke. I will tell you, and the SEC is very exacting on that sort of thing. They do not like it when people break the law. They enforce those things and they win more often than not, I will tell you. They really don't bring enforcement actions. They lose. They can lose. And then others, we got Regulation A, general solicitation is allowed for that. And then there's Tier 1, Tier 2. Commonly used in real estate crowdfunding, as well as other types of crowdfunding, depending on the size of the round. That said, there's additional compliance factors that you have to do there, additional forms you have to file if you're doing a Reg A offering. So just keep that in mind. And then blue sky filings. So, one thing about, Reg D, in certain securities laws will preempt state securities laws. So if we fulfill our duty by filing Form D, we technically will not have to file, certain state securities law filings. That said, when you do this, it's kind of up to you and your client or it's kind of up to the lawyer to sit there and evaluate which states need to be done. So whenever we, do this, we have a cap table, right? Whether it's in Carta or whether it's, in just a simple Excel spreadsheet, and we put all of the client's information in there. We basically, create a list of all the states where these people are from, where investors are from, and we evaluate, those state laws to make sure whether or not, there is an absolute need to whether there's an absolute need to file certain state securities filings. That's what we call a securities memo, right? We're just telling people, hey, this is, we're just wrapping up, and usually we provide that memorandum on the back end or create it as we are ongoing or as we are doing ongoing fundraising. Okay. You need to consider when you're doing this evaluation, contact with a person in that particular state. Where is the institution or investor located? Where is the company selling stock securities located? Is it an intrastate offering? For certain intrastate offerings. So let's say, you exclusively sell stock in your company, it's a Texas corporation. It's, only selling to Texas residents, and we can verify that information on the investment documents. There's going to be address information for all those people. In that situation, we know for sure that it's an intrastate offering. We potentially, would only need, to comply with state securities laws in that respect. Because technically you haven't brought yourself under the jurisdiction of the Securities and Exchange Commission until you have actually done something in interstate commerce. That brings you under federal jurisdiction, right? That said, continuing on, I've already talked about Reg A, but let's talk about Reg CF. Basically, the non-exemption exemption, like I said before, effectively requires everything you would need to do to register a public offering, except it applies to crowdfunded private offerings. The max private offering was raised not too long ago from 1.07 million to 5 million, which I think makes a lot of sense. To give you an idea, if you're doing a Series A, $1 million is really not a ton of money. Okay. Like we're about to do a Series A for a company that's doing a $35 million fundraise at a $300 million valuation. Okay. Like that's like, to give you an idea, we're looking at Series A's of, somewhere in the range of 2.5 to 5 million, and we're looking at, a lot of money, a lot of capital, a lot of strength, from the institutions that are actually going to be providing that money. They're going to be very strategic for us, for our client companies as far as their continued growth. And when you do a large, private offering, I will say, you should pretty much expect, Series B, Series C coming down the line, and then thereafter shortly probably doing, a public offering of some kind later on, if necessary, or an exit where you get acquired. And as far as Reg CF goes, the offering must be conducted through a registered fund portal. Those things must be registered, with the SEC as a fund portal in order for you to do that. Or you yourself, if you're operating a fund portal, you need to obtain registration if you're doing crowdfunding. New accredited investor requirements. Expanded list of individuals who are accredited investors. This was, a change that came about last year. I think it was, a good change. It did actually change, something slightly. But I will say, I probably think they need to go a little bit further here. For people who hold certain professional certifications. So let's say, you hold one of the series licenses, that are required for a stockbroker or, somebody who does, advisory work, for people as a wealth manager or something like that, or a hedge fund manager. You're probably, you're probably going to qualify as an accredited investor just by virtue of this, of those licenses, right? I mean, that said, to give you an idea, startup attorneys that do this all day long, if they're not millionaires, or not making, 200 or 300,000 a year, then they technically don't even qualify as accredited investors, which I think is a bit asinine. In my opinion, those people who do this every single day, who literally draft contracts for deals of this kind, they can probably identify pretty well, almost better than, a lot of other people, whether or not a company is doing something right or doing something wrong. And, they probably are a pretty good judge of whether those companies are good companies to invest in, because they see, a lot of stuff, including financial statements for those companies. They can tell how healthy the business is, if they know how to read those financial statements. So that's it. I think they need to expand it, but this is the current list, of expanded, people that are covered. And then, here are some other things, as far as limited liability companies go, you got to have a total assets in excess of 5 million, and you can't be formed for the purpose, specific purpose of acquiring securities being offered. That said, as far as the purpose goes of the company, something you probably do, in order to overcome this issue, if you're forming an LLC, for the purpose of making an investment, a special purpose vehicle, I would say, in some cases, the operating agreement might mention this sort of thing to ensure, that it's very clear that it's not formed for the specific purpose of, just investing in that. Because we see, this is what we're getting after here is, investment company requirements. If you qualify as an investment company, then you're required to register and do certain things, which we don't want, right? Any other type of entity, well, yeah, I'll let you read that. The reality is, the short and sweet to this is, most of the people you'll be going after as far as investors, you're going to want them to have at least $1 million, in total net worth. Okay. And then, or you're going to want them to make 200 or 300,000 a year, and 200,000 if they're an individual, 300,000 if for a married couple. Okay. That's really the threshold here. So step one, for running a private offering, like let's say you get, you're about to run a private offering, you're going to have to go get what's called a central index key. Your lawyer is going to have to do this, or you or whoever is advising you on your capital raise is going to have to do this. The central index key is basically just a code, with a password that is used, to obtain other codes that are then used to file what is called Form D and, file other securities filings with Edgar. Edgar is the website. It's basically the dashboard, which I will tell you is not a very interesting looking dashboard. It actually looks a lot like, it looks like it was built on furniture store grade software from 1999. It is not very pleasant to read, and it is not very useful, I will tell you, if you have problems with it. That said, they've gone completely on, the SEC has gone completely online since last year with securities filings, which, they should have done that before. I would say I've filed securities filings in California before and can tell you that securities filings in California are probably the easiest to file. As far as filing them with the federal government, for some reason, it's just hard. I don't understand why, but it's whatever. Maybe that has something to do with, our industry as a legal industry wanted to protect itself, by making it more difficult to do this job function, which I completely disagree with. I think everything should be as easy as freaking possible. Common that, it's pretty common that attorneys will set up the CIK for you when they start your Delaware corporation. Just make sure you get a copy of what the CIK is and what the password is. Okay. You need both of those things. You also want to make sure that, if you're the founder of the company, that you're potentially listed as a point of contact, for that CIK. I had an instance where we had a client that was not, where the CEO is not listed, as a point of contact for that, which I thought was wrong. The attorney was listed as the only point of reference. And, we have to go change that person's, we tried to change that person's password for their central index key so I could file securities filings. And let me tell you, like, there was literally nothing, almost nothing I could do. Like, I had to get a written notarized document just to change the password, which is insane. It should never be that difficult. But you're going to have to sign a limited power of attorney, basically saying that you have, authority to file securities filings on behalf of the person. It's probably a good question to ask your lawyer if they did not do this for you, if you discover that you don't have a central index key. To give you an idea for Form D, typically most people are going to file Form D at the end of their capital raise, not at the beginning. That said, I think it's probably better actually to just file an initial Form D and then file an amended one later. That way, the fundraise is actually discoverable. We know what the start date was. Everybody can go search it. They can go into Edgar, type in the name of your company and pull up the fundraise and see where it's at. Right. Aside from that, figure out deal terms and get your deal docs drafted. So instrument types, most common we're going to see are safes, convertible notes, and stock purchase agreements. There are other instruments that might come into play: warrants, stock options, stock appreciation rates. But generally this group, the first three, safes, convertible notes, stock purchase agreements, are going to be the type that we see. Aside from that, though, the type that we don't see as often, but that is still relevant, are going to be loans that qualify as securities. Okay, so basically convertible notes that are not the standard startup convertible notes for early stage companies, but are actually secured, what we call secured loans, right? Secured transactions. Basically, it's a long-term loan greater than 9 months that's coupled with a security interest. And the security interest is secured in usually tangible personal property, that the company owns, as well as its cash assets, right? So just keep that in mind. If you're doing like a bridge loan, right, and the bridge loan is secured and it's longer than 9 months, it technically qualifies as a security, and you're going to need to put securities language in there, as well as file securities filings with the state or with applicable authorities, the SEC, or if it's an interstate transaction, you're going to need to do a state filing. If necessary. That's if the statute actually requires it. Sometimes it doesn't. Term sheets are important, though. I do want to let you know, like, whenever we're talking about, term sheets for pre-seed and seed stage, I would say term sheets not as common as we see when it comes to the later stage rounds like Series A. Term sheets are pretty important. They do set the expectations of the round. They tell us what the economics are, and they tell us what we're going to see as far as an investment goes, and what key terms, material terms, need to go into that document. Subscription agreements are important as well. They're going to contain wire transfer information. They're going to contain all the stuff that hey, this is not accepted until it's deemed accepted and signed by somebody who's an authorized representative of the company. And that's important because if for some reason the person doesn't qualify as the proper type of investor, then the subscription is going to be rejected and the person is going to get their money back, right? Aside from that, you got to fill out accredited investor questionnaires. and certifications for Rule 506B, Rule 506C funds, and really generally any other type of investments. And then side letters. Most people don't know what side letters are. Side letters are, in other words, side deals. So let's say, we have an offering, right? We're offering a safe, and this is the version of that safe. But we also have, a disclosure which says the company itself can vary the terms of the safe. Depending on the type of investor, the board, has discretion, or the company has discretion to do that. That's important. Sometimes we do actually do that. We did a safe where there was a side letter involved, where we granted, a right of first refusal, in addition to the investment itself, which was different than all the other investments that we had done. We didn't want to put that into the safe itself. And that's important because, us as lawyers, I don't want that document getting reused. I don't want a document that has expanded terms getting reused and given to somebody else just by accident. So it helps us separate out that transaction from the rest so that we don't have any issues. But it's very useful in that, it's basically incorporated into the agreement as a side letter agreement, right? Step 3, find investors over the next 12 months. You have a 12-month period in which you are able to raise money, okay? It's not just the general standard, like I say here, that's actually a legal requirement. You're not supposed to raise money for more than 12 months. Otherwise, you're considered to be doing a public offering, in which case you have to register the offering, right? So make sure you're not doing it for more than 12 months. I've seen, and by the way, there is a certain waiting period that I think is necessary between certain rounds of fundraising. I've seen certain people, and you might have seen certain people in Silicon Valley who will sit there and say, oh, we're doing a, capital raise for, a seed round, and it's 500,000, and then we're going to do a $2.5 million Series A 3 months later. I think, as far as a waiting period goes, 3 months is pretty close. I've also seen people do it a month or two after. I'll tell you, that is extremely close. The closer your capital raises are to each other, the higher the likelihood there is of the SEC doing what's called integrating the round. Basically, they're going to take that seed round and that Series A, and they're going to consider that to be one full round. And if that amount of time actually takes longer than a year, then it's possible that you're in violation of the 12-month rule here. So just keep in mind, the further apart those are, the more of the case you make for not having the round integrated. Okay, for not having the seed be considered, a seed and a Series A, right? And so, just keep that in mind. I'm not saying that you can't do it. I'm saying talk to your lawyer about what's best there, what they've seen, in your geographic area that is acceptable, for a company like yours, and what's compliant with the law. Okay. Ensure the accredited investor certification or questionnaires are properly filled out. We started a business on October 27th as a real estate venture fund. We started the limited partnership on October 27th. To date, that fund has raised $4 million. Okay. Of the $4 million raised, the accredited investor certifications, have been filled out by maybe 30% of the people that have signed. Okay. I will tell you, at least fully, right, or properly. I've seen a couple that were filled out, but they were filled out improperly. I've also seen a couple that were, the person signing was not a person, but an entity. So the type of, form that they filled out was actually not the proper type of form. In that case, what we do is we follow up with the client. We follow up with the investors. We tell them, hey, we just need to confirm that you're an accredited investor. Can you please tell me which of these you qualify as? Sometimes that can be as simple as an email. It's either that or, even better, what we can do is we can just resend the certification without the rest of the contract. And we can just add that to the executed bank of documents and consider that done. That way we don't have to resend the investment documents or sign something terminating the originals and then, signing new versions, right? That said, potentially require people who are borderline accredited investors to obtain an attestation letter from an attorney or an accountant. I prepared one of these during the summer. It's really not as common unless you're doing a certain type of round, such as Rule 506C round, in which, the person is actually, they're double checking the person's net worth, and they see that the person is really close. In certain cases, there's, and also, by the way, when I did this review, I literally had asked this person, I need your, I basically had to tell them, I need all of your bank statements, current bank statements that show what you have as cash in the bank accounts. I also had to tell them, I'm going to need to see ownership of property, including your homestead. I'm going to need to see remainder of liabilities and outstanding liabilities and credit card bills, things like that, because we take your assets, we subtract your liabilities, right? And, we do the calculation. I mean, that said, there was an instance where I was looking at it and I was saying, this person had rental properties, several rental properties, and, they were borderline. It was like their net worth was like 990,000 and the threshold was $1 million. As far as appraisals go, what I did was I actually relied on a Zillow, potential appraisal, which said that, hey, the value of this property is not the appraised value by the appraisal district. It's actually the appraised value and the potential value would get at sale. And that's what sent that person over the top. It made them, worth about $1,050,000, right? So in that case, I told them, look, your net worth is potentially going to fluctuate. You're making the case for this right now. You might not be an accredited investor in the future if you spend money, right? So just keep that in mind. We're not always trying to make the case in that situation. It's my preference not to. But in that situation, there was a very clear way in which I could tell that person was accredited, and it was through real estate ownership, right? Step 4, ensure that funds transfer to the company. This is, not something that is, I guess, top of mind, right? You think, oh, this person signs it, they're going to wire it to me. I just maybe have to follow up with them once or twice. There are instances, though, in which an investment gets made and then the investor decides, no, I'm not doing that anymore. Or they decide, I am not going to transfer the full amount of funds. I'm only transferring half, or I'm only transferring what I want. You're going to have to send me, edited documents. If that's the case, send them amended and restated documents with the number changed. Okay. We want to make sure we amend the document if they're still going to invest. That's it. If they're not going to invest, a couple of things need to be done. Either according to the subscription agreement, notice needs to be provided if it's in there, the language is in there, that the person has not funded within the period of time and therefore they are not an investor. The other thing that needs to be done, if the language is not in there, is a mutual termination agreement needs to be signed and notice needs to be given to that person that they have not funded and they are in breach of the contract, right? You can, by the way, if there's not language in there and somebody signs, if there's not language in there allowing for termination just by virtue of the fact that the person didn't fund, or basically rescission of the investment document, like as a result of the person not funding their investment, then at that point, what needs to happen is you do need to notify that person 100%. Like you have to have a written notification to that person, prove that you actually did notify them, and demand the money. It doesn't need to be hyper aggressive. You just need to say, we have not received your funds today. Please send them. That said, if they fail to do that and they have the money and, they're, and you've done everything else right, you could potentially say, I'm going to bring, a specific performance action against you, basically sue them and, ask the court to order them to pay you money. That said, I don't really recommend specific performance in this situation. And here's why. It's the quickest way to get accused of securities fraud. Those people are going to sit there and dig around your PPM. They're going to dig around all the disclosures and all the stuff you sent them. And they're going to try to argue probably, and potentially validly that you committed fraud in some way, right? and that's why you didn't invest. Or they're going to potentially, come up with whatever cause of action they believe is the case and report you to the SEC and file a complaint, which is not what we want, right? An inquiry from the SEC. There are a lot better ways. I would rather not take people's money than take their money and then have to deal with an inquiry from the SEC. It's not the way we want to do things. That said, escrow arrangements. Sometimes we do these for larger deals. So let's say, we're doing a $35 million deal, right? It's possible that we'll have a third-party escrow company escrow the money. We'll have an escrow agreement that goes along with the transaction. And we'll say, okay, the threshold for release of funds is 10 million of the 35 million. Once we hit 10 million, we know that the fund is likely going to close. We do want it to close. We want to say that the initial closing will happen, and the money will be sent once we hit that threshold. So I think that's it's a smart way to do things too, especially if the companies are investing only because they want it to max out. Like, once you hit those higher numbers, we see this a lot, companies, they get some early traction as far as investing goes. And then sometimes they just go, oh crap, like I'm having a hard time getting money. And then all of a sudden they get a $250,000 investment and the rest of the dominoes fall. They get a bunch of other investment and then they close their round. That happens sometimes. And, sometimes an escrow agreement, for an escrow arrangement makes sense because you want the company, it also says, hey, we're going to have access to all these funds once, this transaction closes. You can basically tell the investors that are about to close a deal with you. That said, escrow arrangements, have we done one recently? Not really. That said, for the $35 million deal that we're about to do, it's possible we may actually, have to do that, but that's only because there's just so much money in play. And also because, I don't really want to deal with people who don't have, I don't really want to deal with people who don't have the money like that circled up. That's another way to verify. By the way, escrow is another way to verify if money is circled up. If you tell somebody, I want to do escrow, and there's really not a reason for protesting it, and they say no, then the question I start asking is, what do you mean? Do you not have 35 million? Like, do you not have 5 million? Do you not have the money circled up at all? It's good to know that you have the money circled up beforehand. And then step 5, update Reg D and other securities filings once round is closed. Attorney should draft securities filing opinion letters, letting you know which securities filings must be made, which states require a filing regardless of exemption, which do not. Once a round is closed and all investors have been placed on a cap table, finalize that information and then file an update to your Reg D. And even better, maybe even send it to your, notify the investors that a Reg D has been filed, and they can go now search for the company and see that the round has officially closed. And that it sometimes makes them feel a little warm and fuzzy inside to know that you've done everything right. It inspires a little more confidence, I will tell you, in you as a company and you as a founder or an officer of that company, if you're actually notifying them and updating them of that sort of thing. And that's another important thing I want to talk about with fundraising. Make sure that when you're doing fundraising, you're giving incremental updates to the people that have already invested. It might take a year for you to get all these things, for you to close your round, right? That said, I'm not you're going to experience a little ebb and flow. You're going to have cash come in, and then you're going to have a little period of time where it's going to be, you're going to have cash going out and then potentially be cash strapped. From a business planning perspective, you need to keep your investors alert, especially, keep in mind, like the reason why it does make a lot of sense to let them know, where you stand as far as investment and, how much money you're spending, is because it'll tell the investors whether or not you need more capital. Sometimes they'll say, hey, they'll bring their friends in and, invest. Sometimes they'll give you more capital and sign another safe or convertible note for more money. So just just keep in mind, your investors are oftentimes, your current investors are oftentimes, the next likely source for additional investment. And sometimes we do tell people, look, as far as convertible notes go, as far as safes go, we don't necessarily have to amend a safe. We can sign 2 of those. We can sign, 2 for 2 different amounts based on money they want to invest at a certain period in time. Right. That said, I will tell you, we have reached the end of our slides, and we've reached the end of our presentation. I'd like to open it up for comments, concerns, questions, if anybody wants to ask any. If not, just keep in mind that next year is a new year. I mean, go in, be motivated, be excited about it. I think we're going to see a bonanza as far as startup investing and startup growth for the next year. The market is kind of hot right now, I will tell you, but it's not overheated in my opinion. It's actually very efficient. It's very active, and people are going to be minting billionaires every single day in the startup world next year. And I hope one of the people listening to this is one of them. Anyways, that said, we'll be here on the first Tuesday of next month. I believe that'll be January 4th. Feel free to sign up for next month's webinar, and we'll see you then. Take care, everyone. Bye.